frankly, one of the reasons I'm more optimistic about prospects for REITs overall, whether it's specialty sectors or not, is that really the run up in construction costs and the supply having abated in sectors like industrial, I think is really a rebalancing. That means, yeah, there will be some bespoke development in places like data centers, but I don't see a meaningful rebound in any of the sectors over the near term that give me cause for concern, at least over the next 2 years.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. My guest today is Seth Laughlin, Head of Real Estate Strategy and Research at Cohen Steers. Seth joined Cohen Steers in 2025 after previously serving as Head of U.S. Market Research at Green Street. He's also worked as an institutional REIT sector specialist at Merrill Lynch and a REIT analyst at ISI. Seth is with me to discuss the major forces shaping REIT and listed real estate performance today. Seth, thanks for joining the podcast.
Happy to be here. Thanks for having me, Sarah.
So, Seth, to kick things off, can you talk about how REITs have performed so far this year? And has any particular message or theme emerged from the first quarter earnings?
Yeah, it's been a really interesting year. REITs were off to one of their best starts to the year through February, and best on an absolute, but also on a relative basis compared to the S&P. And that was really a relief and driven by a couple different things. Really, the Mag 7 dominance of the market over the last 2 years had moved investors away from stable growth or stable income into growth. What we had seen in the beginning of this year is a broadening out of the economy, an appreciation for hard assets, an appreciation for stable income, and REITs were definitely a beneficiary of that. Then we had the conflict in Iran, the market sold off. REITs have really hung in there on a relative basis throughout the sell-off and then have rebounded in line. So they're still up double digits, call it mid-teens, versus the S&P up, call it mid-single digits. But a lot of that outperformance was in the first part of the year, and they've been keeping pace with the broader markets through what was going on in Iran. In terms of earnings, we're still early, but there's for sure, I think, a broad theme occurring, which is it's all about expectations. And what I mean by that is we've seen some pretty wide dispersions in sector performance a year to date, even this early in the year, with sectors like shopping centers really performing well, sectors like apartments really underperforming. So you see this big dispersion. And I think the theme for earnings was, where are expectations relative to performance? So we're seeing pretty strong earnings reports from those shopping centers, but they stalled out in terms of performance. And on the other side of it, apartments have been really underloved in the industry, and earnings were okay, but they seemed to perk the stocks up a little bit. So it's really about these pretty wide dispersions in performance and what that means for expectations during earnings season. So it's all about hitting those expectations.
So would you say that REIT execs have tried to tamper down expectations?
No, I don't think it's as much as their messaging. I think most of the guidance that was given with fourth quarter earnings have been fairly stable. So not big swings in changes for expectations for the full year. It's just the performance of the stock going into those earnings releases. So again, shopping centers, pretty good reports, but because the stocks were up so dramatically to start the year, the bar was just very high. And similarly for apartments, the bar was very low. So even though there was nothing to write home about, the stocks have actually done pretty well post-earnings.
And you've already touched on the conflict in the Middle East. So REITs have really performed quite well during that period of volatility and uncertainty.
Yeah, like I said, they had a huge head start outperforming the broader markets. And instead of giving most of that outperformance up and then coming in line with the broader markets, they really held on to that outperformance. So if you're thinking about REITs up 13% versus the broader market up 6%, that's a pretty healthy amount of outperformance that they've been able to maintain through the Iran conflict.
And Seth, what about positioning in the sector? Would you say that's more important than ever these days?
Yeah, certainly in my 25-year career, just thinking about the changes that have been driven for consumer and corporate behavior. Certainly e-commerce was a trend that was happening before the pandemic, but that was an accelerant that caused a fairly sleepy sector like industrial to catch fire. And then the bellwether sector for at least the earlier part of this century had been office buildings, and they really have fallen by the wayside. And so you're seeing these massive divergent performances at the sector level, even after the pandemic, the supply imbalances that occurred after the pandemic, demographic changes, whether it's senior housing accelerating or the demographic that is most likely to rent apartments is decelerating. So we're just seeing these massive changes in consumer and corporate behavior. And now as we look forward, I think AI is going to be the next disruption to how the economy takes space. And that's really what REITs are. We're the landlord to the broader economy. So you're hard pressed to find a headline on the cover of the Wall Street Journal that can't be tied back to a landlord at some point. But I do think sector allocation is going to be crucial as we seem to be accelerating these disruptions in the economy.
Right. And we have seen quite a lot of M&A activity in the last few months. What's behind that? And do you see certain sectors that are more active in that space?
Yeah, I think that's right. I think one of the distinguishing factors has been the size of the public companies that have been taken private. So like the headlines of late have been public to public. So Public Storage and NSA was the most recent. Obviously, there were headlines about EQR and Avalon. So I kind of set those aside as public to public, not much big dispersions in valuations. It's really strategic opportunities within those companies. What's more interesting to me is the smaller M&A that we've seen. So those smaller companies getting taken out by the private market. I think that's fairly consistent with what we've seen over the last 4 years, which was the listed market took a much more dramatic impact from the Fed hiking cycle and has been slower, at least, to see some of these major property sectors get back to valuations, whereas the private market continues to lag. I mean, one of my best examples I like to call out is, right now in the apartment space, it's incredibly cheap to buy apartments relative to the private market and the listed market. The apartment REITs, which are great management teams, trading at a 6% cap rate compared to where those assets trade in the private market at 5.25, huge disparities. And so you're starting to see at a certain size that being able to take advantage of going from the listed market into the private market. And I expect that continues.
And so do you think there'll be more activity in those mid-tier companies?
Yeah, I think for now it's going to be the smaller companies in the sectors that have accelerating operating fundamentals. So Sila and in the healthcare space was an example of that. So I think you'll still see that mid to small size M&A.
And what about IPOs? Are you optimistic that we might see some activity on that front?
Certainly the performance that we've seen in the REIT space year to date is going to help that. I think it's going to be very sector determinative. So to the extent there are sectors that are trading at big premiums to the private market value. So examples, you can see a lot of activity in data centers, right? That's a place where the public market has been certainly rewarding that property type. But anything like apartments, as I mentioned, where the listed market is trading much lower on a valuation basis than the private market, there really isn't a catalyst to have them come to the public market. The other potential thing to look out for, not seeing it yet, but certainly to the extent there was distress in any private vehicles where they were looking for capital and needed the listed market or the public market for a source of capital. We've seen that in prior cycles. That's nothing that seems to be on the horizon today, but that could be an interesting evolution if there were certain vehicles or institutions that put together portfolios at the top of the market in the last cycle that are struggling to find a way to recapitalize. Could the listed market be an option for them? That's something that could happen, but certainly not seeing any evidence of that now.
And how do you see public versus private real estate playing out for the rest of this year? It's something that our listeners are always interested in.
Yeah, I hate to be myopic, but I do think it depends on what you categorize as private market. Oftentimes, I think we're using the Odyssey index as the stand-in for private. And it's just important to remember that close to 65% of the Odyssey is held in industrial and apartment sectors. When I think about those two sectors in the private market, cap rates have stayed stubbornly low. Debt spreads are pretty low as well. So I don't see much opportunity for cap rate compression in the private market for roughly 65% of what you would call Odyssey. So it's really going to be a growth story. There's a lot of embedded NOI growth for the industrial sector, we all know, because rents had moved so quickly through the pandemic. There's still some mark-to-market benefits, but I'm more worried about the apartment NOI growth story in the private market, we've finally seen peak supply in our rearview mirror, but that supply is still working its way through the system. At the same time, if you're looking out over the next 5 years, the renter age demographic that is most likely to rent apartments as a whole will be shrinking. And so you're seeing that headwind both from just the overall population, the size of that pie, but also you're starting to see some concerning statistics about unemployment rates for young adults. That's the top of the funnel for apartments. So I'm more worried about income and frankly cap rates for apartments in the private market. So when you're talking about 65% of the index in the private market sort of treading water, I think it's going to be a mid-single digits, somewhere between 5 and 7% returns when the year is done on the private side. But there will be sectors that will perform much better. I'm particularly optimistic on shopping centers in the private market. They've worked over the last couple of years, but I do think there's a bit of a retail renaissance that's occurring there. You're starting to see cap rates get lower and lower as investors take notice of what is a really attractive imbalance between supply, which is close to zero, and assets still trading at meaningful discounts to replacement costs. So no real signs of supply coming in the near future. And at the same time, you're seeing occupancies that are at or approaching record highs. And then to add on to that, we had a little bit of a hiccup at the end of 2024 with some larger big box bankruptcies, but that largely has been filled. And we've moved through that in the end of 25. Didn't seem the same level of bankruptcies. So I think there's going to be some tailwinds to that sector. So it really depends in the private market, what sector you're talking about. But if I'm thinking of Odyssey overall, it's going to be in that mid-single digits where, as I mentioned, REITs are already off to a really good start and low double-digit returns year to date, which I think is sustainable.
Just jumping back to multifamily, do you see that sector being helped at all by older generations or retirees who want to downsize? Could that offset some of the issues at the other end?
Yeah, I don't see it as a meaningful contributor, especially within what we consider core multifamily. There is age-restricted multifamily that probably stands to benefit from some of that, but the vast majority of what we think of as institutional multi is not going to be age-restricted. And really the demographic benefit at the longer or more age spectrum is going to be accruing to senior housing rather. And so that, to me, is the bigger beneficiary. I don't think a downsizing is going to be enough to offset it in the near term.
I'm turning to development now. Do you see that really being driven as you look ahead by next generation real estate rather than those traditional sectors?
I think a prime example of that is the data center sector, which by all measures, demand is still outstripping supply, but that's where you're seeing the most aggressive in terms of development starts and completions. I think we will see some in senior housing as people begin to get capitalized. So I think that is the next gen that will see some development. But frankly, one of the reasons I'm more optimistic about prospects for REITs overall, whether it's specialty sectors or not, is that really the run up in construction costs and the supply having abated in sectors like industrial, I think is really a rebalancing. That means, yeah, there will be some bespoke development in places like data centers, but I don't see a meaningful rebound in any of the sectors over the near term that give me cause for concern, at least over the next 2 years.
Seth, we've covered lots of ground today, but any additional areas that you think are really interesting or catching your attention today?
Listen, I think there's always headlines day to day that we stay focused on, but it's important to pick your head up and think longer term. When we look back at where a lot of money has been made over the last 10 years, it's people getting ahead of the Sunbelt migration, people getting ahead of e-commerce, people avoiding work from home hits to the office. So we're constantly trying to think of what other themes could be out there. I think for sure AI adoption and what that means for the broader economy, what that means for certain sectors, whether it's a meaningful headwind for office, a meaningful headwind for apartments, or whether that changes the landscape geography-wise in terms of where people can live. I think you have to have a lot of humility in terms of how it plays out, but really trying to stay on top of what the news flow is for AI and being contemplative of what that could mean for various property sectors. So that's one we're thinking about. I think the other is the trend of deglobalization, whether you're thinking about tariffs from last year, which are still at least continuing with us today, or whether it's the war that's persisted in Europe, or the conflict now in Iran, it does feel like we're beginning to look more inwards, either regionally or within the country. What does that mean for different markets? Could the Midwest be part of the manufacturing renaissance? I'm still a little skeptical. We haven't seen that happen yet, but what could be the implications if we're the early innings there? So I think that's another one. And then, the massive migration patterns to the Sun Belt markets, I think it's really important to get an understanding of how sustainable that is. Are some of the, whether it's political or legislative arguments that are being had in the blue states that are potentially driving businesses and residents to red states, is that something that continues? Does it get worse? Does it normalize? So I think all of those are things that are bigger picture that you try to keep your eyes on, because it could change the landscape pretty dramatically.
Do you see the potential for any new REIT sectors to emerge? I'm not quite sure what form that could take, but I feel with technology moving as fast as it is, there could be something out there.
Yeah, I don't see as much as new sectors popping up. What I do think is more likely is sectors that had been in existence. So I'll go back to my example of data centers. They've been in the public market for 20 years. No one was as aware of data centers as they've been in the last 5 years, but we call that sort of a new sector to the rest of the world. But for us, it's been around 20 years. So I think it's something that can happen where the sectors that are currently in their nascent form and REITs can grow and relevance. And I think that's probably more likely than something coming out of nowhere that we haven't thought of.
Seth, thank you so much for your time.
Yeah, absolutely. I enjoyed the conversation. Thanks, Sarah.
Same here. Thank you. And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.